One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week where we get the latest take from Todd Rosenbluth, the head of research at VettaFi. And if you go to VettaFi.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely exchange-traded funds that we discuss here. Todd Rosenbluth, great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
the Vanguard FTSE Emerging Markets ETF, VWO.
VWO, the Vanguard FTSE Emerging Markets ETF. It's not quite the granddaddy of them all, but this is like the original old school. If you're going to have an ETF that's going to do something beyond domestic plain vanilla kinds of investing, this was it. So why this fund back in the spotlight now?
You're right. This is not a new fund. It's been around for more than a decade. Why I'm highlighting it today is a couple of reasons. One, emerging market ETFs have performed well out of the gate, and they've been very popular. In the month of January, a record was set of over $20 billion of new net inflows going into emerging market equity ETFs in an individual month. And then Vanguard made news, as they often do in January or February, with bringing down the cost of their existing funds. So Vanguard cut fees, or the expense ratio, on, I think, more than 50 different funds, mutual funds and ETFs, and VWO was one of them. So this broadly diversified, index-based emerging market ETF now costs 6 basis points. So it's even cheaper than it was before. It's even cheaper than the iShares comparable fund for many people.
Before we talk about the fund, because as you always point out, look, when we start talking about a fund's returns, they are net of expenses. So at times when expenses are a little bit higher, you don't worry. But one of the interesting things here with expenses is that emerging markets historically has been one of those places where you said, if I want it represented in my portfolio, I have to be willing to pay a little bit more in expenses to get it. And obviously what this fund is proving, that's not so true anymore.
That's right. So, I mean, Vanguard products typically are below average in their overall fees. I'm looking on Vanguard's website. They've got a statistic that says the average expense ratio of similar funds, and this is including mutual funds, is over 100 basis points. So the fact that it's 6 basis points for VWO is really cheap. Now, you can find other similar low-cost, broadly diversified emerging market ETFs available. iShares and State Street and Schwab, I believe, also offers examples of products that are taking the largest companies within the emerging markets index. But each of them is constructed a little bit differently. But yeah, if you're looking for a low-cost fund and you don't want those fees to eat into your returns, VWO is a great way of doing that.
The rest of this story has to be about emerging markets now.
It is. So, I mean, emerging markets outperformed in 2025. Not as many people paid attention to it. And that's why I think we saw emerging market ETFs gather a lot of money in January, because people were catching up. We've talked about a over-concentration in U.S. equities, and certainly in large cap U.S. equities, and the S&P 500 based ETFs like VWO, which is Vanguard's product, remains extremely popular. But I think investors came into 2026 wanting to diversify and actually diversify away from U.S. large caps. So with emerging markets, you get that diversification from a international perspective, certainly from certain countries, adding in China, adding in Taiwan, adding in India, which hasn't performed as well, and South Africa and Brazil. Those are the 5 largest countries within VWO. But the fundamentals have improved. It's actually a better place to invest in emerging markets than it's been. Valuations have been attractive, but the fundamentals, based on the data that I've seen, look much stronger than they did before. And certainly the I'm sorry, certainly the returns or the performance has been much stronger than it was for U.S. equities to start the year.
Yeah, I mean, emerging markets funds are up more than 5% year to date as we record this. But the flip side, when we're talking about performance and with ETF of the week, is that frequently you are highlighting active managers these days where you're looking for something that's going to give you a performance edge. And the one thing I will say about VWO, yes, it's old school. Yes, it has been around for a while, but it's not ever necessarily been this is the star emerging markets fund. In fact, relatively speaking, this has been middle of the pack among emerging markets funds. So obviously the diversification factor is the big thing that you've been discussing, but this is something we don't talk about a lot. If somebody hears you goes, okay, I get the message on emerging markets. Maybe I should go put more money there. And then they go look at this fund. Doesn't at some point performance matter? If you're saying I want performance I want an asset class, do you just want the representation or do you say, give me the hot player?
Well, so I think what people are doing more and more is pairing an index-based approach with an active approach. So the steady eddy of broad emerging markets in a low-cost manner, VWO fits that bill. It will give you the exposure. In fact, that's what it's intended to do. It's not trying to outperform anything. It's trying to replicate a benchmark from FTSE Russell, which is one of the leaders in international equity benchmark strategies. VWO is trying and does a good job of replicating the performance and the exposure that you'd get in a broadly diversified emerging markets ETF. Now, there are going to be funds that outperform in a given year, and there are going to be funds that underperform in a given year, and those are likely to bounce back and forth. Many people are looking at the benchmark as their reference point for an active management. So I think you could have a low-cost product like VWO as the core of your international equity exposure, and also pair it with an actively managed strategy. Have somebody that has more bottom-up stock picking and a narrower universe, whether that's an ETF, as I think many more people are choosing, or a mutual fund. But yeah, costs matter, and that 100 basis point difference between the average fund, which is often mutual funds, and VWO is going to eat into your return. So I like, and I think many people like, a broadly diversified, low-cost international strategy to be part of the core. VWO does that very well.
Because it's part of the core. And I recognize you do not make individual portfolio recommendations for folks, but given that this is a base emerging markets fund and that you might want international exposure to other parts of the world as well, roughly how much of a portfolio, like what's a range that's appropriate for this in somebody's portfolio?
So I'm going to back up slightly. Typically, we see people start, they don't always stay, but start with a 60% equity, 40% fixed income allocation. Obviously, there's some other asset classes you could fit in there besides stocks and bonds that we've talked about. So of that 60%, many people have probably 2/3 of that towards U.S. equities and a third towards international. So that's roughly 20% of your portfolio that's in international equities. And I think you want to have a healthy mix of developed and emerging markets split between. So it could be somewhere between, I guess, 5 and 10% of your portfolio if you're willing to take on some risk. Obviously, emerging markets, the name emerging markets and an ETF like VWO is higher risk, higher reward than what you would find in a developed market like Europe or a developed US market that people tend to have exposure to. But 5 to 10% is logically a good place to start for your EM equity exposure.
And if you are looking for more EM exposure, well, the VWO, the FTSE Emerging Markets ETF, a place you might want to look. It's the ETF of the week from Todd Rosenbluth. Todd, great stuff as always. Thanks for joining me.
It's a real pleasure, Chuck.
The ETF of the week is a joint production of VettaFi and Money Life with Chuck Jaffe. And yeah, I'm Chuck Jaffe. And if you want to hear more of my talk Go to moneylifeshow.com or search for us on your favorite podcast app. Now, if you're searching for more information on your favorite ETFs or maybe your next favorite ETFs, the kind of stuff we talk about here, check out VettaFi.com, where they've got a full suite of tools that will make you a savvier, smarter investor. They're on X at Vetta_Fi. Todd Rosenbluth, my guest, their head of research, he's on X as well. Follow him at Todd Rosenbluth. The ETF of the week is here for you every Thursday. Make sure you don't miss an episode by following along on your favorite podcast app. And we'll be back with another ETF for you to consider next week. Until then, happy investing, everybody.